What will happen if the interest rates increases? Lily works in the corporate sector and she keeps herself updated with national international current affairs. Lily gets to know that in times of rising inflation, Reserve Bank is also looking to raise interest rates. The Central Bank of America Fed has already increased rates. She is wondering if the rise in interest rates will be beneficial for her or not. If interest rates increases, then borrowing will become expensive, but you will also get a higher return on your savings. But Lily also has one more issue, that is shares. How will this impact her shareholdings? Is it good news or bad news? Her tension is justified and there are various people like her who wants to understand this issue. So let's solve this complex problem. First of all, Lily must understand the interest rate cycle. This means know when interest rates rises and when do they fall. It is also important to know the cycle we are entering. Supply disruptions due to COVID and now due to the Russia-Ukraine war, inflation is rising rapidly. In the US, inflation is at a 40 years record high. From crude oil to edible oil, everything has become quite expensive. US Federal Reserve has already increased the interest rates and more rate hikes are expected ahead. The whole world is in jitters due to this. Even in India, rate hike is almost certain. RBI can increase rates by 50 to 75 basis points. This means the interest rate cycle is turning and we are entering a period of high interest rates. Now the question is, what will happen to the shares that Lily holds?
So interest rates and the markets have a close relation. If the interest rate is high, then the company's profit will decline. Same thing happened in 2012-13. At that time, companies were required to pay 4% of their sales as interest. During 2008-9, due to lower interest rate, the figure was 1.6%. Got it? If not, then look at this figure. In the first 6 months of 2012-13, net profit of companies was 6.4% of sales, while in the previous 4 years, it was 9.2% of sales.
Founder of Teji Mandi and CIO Vaibhav Agarwal says that whenever the US Federal Reserve reduces its bond purchase program and increases the interest rates, then its pressure is felt by markets across the world. However, in recent times, it was also seen that when central banks started rising rates, markets actually went up. Now, the question for Lily is which sectors will be impacted by this? First of all, if there is a rate hike, then its impact will be felt by each sector, but the intensity of the impact will be different. This means some will have more impact while some will have less. Sectors depending on interest rates like banking, NBFC, realty, capital goods and auto sector will have the maximum impact. On the other hand, the FMCG sector will have the least impact. Interest rates are increasing, but there are a lot of positive things in our country. Like GDP growth rate is good, asset quality is improving, while the balance sheet of companies is stronger and cleaner. Now Lily is wondering what's the matter. So the fact is that rising commodity and raw material prices are putting pressure on companies. In this case, if interest rates rise, then their problems will increase even more. So, does it mean that bullish trend in the market is over? That's not the case. Let's look at some history. Between 2010 and 2013, repo rate were increased 3 times. Then, the repo rate went up from 4.75% to 7.75%. But during that time, Nifty rose 18% or 958 points from 5,262 to 6,220 points. And their fear regarding interest rates declined. Money9 suggests, looking at the change in the interest rate cycle, it is advisable that you adjust your portfolio. Investors should invest in such companies which can preserve their margins. In Formula Guru, watch how interest rate coverage ratio gives us an idea about the debt situation of the company.